Hey guys, what's up? Thanks for joining me today. Today, I have something that I think is going to benefit you, even if you're a noob or even if you're a professional. Okay, I think you can take away something from this. It's called Stock Market Cycles, Market Psychology, and the Average Investor. Let me tell you a little bit about my trading journey first. Um, I started my journey being a stock day trader. So I would study technical analysis, study different types of price following strategies, reversal strategies, and I'll be trading broad markets, individual stocks, commodities, anything that had a price, I would trade it. So I did that for about 2 years. And after that, I decided that I really wanted to understand the financial markets from a more fundamental point of view. I wanted to understand how our economy is connected. I wanted to understand why is it that certain companies tend to perform better under different business conditions than others. So because of that, I pursued my CFA and then I pursued my CMT. And then I had the fortune of being hired to become a markets and equities analyst in a large local brokerage. And over there, I would basically write, stock recommendation reports. Buy this, don't buy this. Here are the reasons why. And I would do broad market guidance as well. After that, I had a chance to dabble doing some quantitative finance. So I did statistical research on applying certain strategies to certain asset classes to try to see if there was explanatory power in the strategy itself on that asset class. And that, to me, that was really, really educational for me. I finally ended off being a senior business analyst, and I was doing some finance, doing some operations optimization, and a little bit of M&A research. And that's my journey. So that's how I came to today. And so today, what I want to share with you is a way that helped me personally in those years frame the market in such a way that allows me to see why certain moves happen the way it happens and what is my place within that move. So it gives me a framework, um, clarity among all the noise. So I hope to share with you this today, and maybe we'll take something from it. Let's go. Section 1, the ideal cycle. Before we talk, every cycle is different. Okay, let me just say that. Every major cycle is different. Every economic cycle will be slightly different. Okay, but we still need to talk about some sort of benchmark or a template. So it's easier to talk about the differences between the cycles when we have something to compare it with. So let's talk about the ideal. All right, so let's talk about the ideal economic cycle. So this black line you see over here is not the price of a stock, okay? This is actually the rate of expansion and contraction of the economy. So in this first stage here, the economy is actually going through a contraction. And of course, when the economy contracts, you expect stocks and commodities to be falling. Okay, this is stage one. Um, at a certain point of economic contraction, as commodities and stocks fall, the Fed says we need to juice the economy again. We need to start the engine of growth again. And what they might do is they might decrease interest rates, they might do some QE. When they do these type of things, you find that bond prices increase. Okay, so that's for stage one. Eventually, because liquidity floods the market, making it easier to borrow and things like that, eventually the rate of economic contraction gets less and less. Now we are still contracting. It's just that the rate that it gets worse is less and less. Starts to, um, companies stop firing people at the same rate. People start to consume a bit more than what they used to consume. And when that happens, right, at a certain point, okay, people are going to think, you know what? The rate of contraction has been slowing down, slowing down, slowing down. Maybe it'll just be a couple of months' time before we go into expansion again. And because of this expectation of what's happening in the future, uh, stock investors who are astute in understanding that things are going to improve in 6 months' time maybe they start buying stocks. And that's actually when you get to the bottom of a particular stock market. So the key thing I want to note is that the bottom of a stock market occurs when there is still contraction in the economy. It doesn't occur when there's expansion. Okay, but by the time retail investors, some of them, they don't want to invest until they see more good news. They want to see that the joblessness is getting better. They want to see the GDP increasing. But sometimes by the time you wait for all those things, you're not down here anymore. You're actually down up here. You miss out the entire move. That's why it's so tricky to find the bottom of a stock market, because the bottom of the stock market occurs when there's still contraction, commodities are still going down in price, and people are trying to guess when things are going to get better, but they don't know. That's how a bottom is being formed. But one thing you do know is that once bonds start to spike up, usually, based on history, the stock market will start to recover as well. It's just that we don't know how long. So in the next phase of the stock market, the contraction in the economy is decreasing at a lesser and lesser rate. We're moving towards expansion. And the more that this rate of change improves, or the gradient of this improves, that's when you're in stage 3 and all of your asset classes keep going up. Commodities, stocks, and bonds. And of course, you get into the stage 4 where things are really good. Joblessness is at getting lower and lower and lower. There's not that much bad news, and at a certain point, the Fed goes, you know what? I think that this economy can keep going on its own. It doesn't need help from us. Let's decrease liquidity. Let's now increase interest rates, and eventually bonds start to go down in price. And of course, at a certain point, after the fumes of a strong economy die out, the economy starts to recover, to contract again. Can be for natural reasons, or it could be because of some sort of crisis. In this sense, you had this COVID issue that basically dropped the economic contraction really quickly, just like that. Okay, and when that happens, bonds fall, stocks fall. Eventually, stage 6, bear market, everything basically falls. Yeah, and this is the ideal economic cycle. Okay, and what I have for you here is just statistical evidence of what I just told you. You can check out this piece of research by the Intermarket, and they basically researched in the last basically 100 years, 1900 to 2017. If you check the annual gains of the different asset classes, bonds, stocks, and commodities over the different economic cycles that you've had, essentially you see the evidence point in the same direction, that during early expansion, you see that bonds, stocks, and commodities are all going up. And at the bottom of the market, right, that's when stocks first pop out, basically when you have the rate of change of contraction changes, and bonds have already gone up before that. Okay, so knowing how the economic cycle moves and the different asset classes, how they move with it, let's pivot right now and talk about the psychology of the average investor. So this term average investor, right? I don't mean that the average performance of all investors is the average investor. The average investor is a term in trading circles that talk about a certain type of person, and this type of person has a particular type of performance in the market. Let's just see what is the historical performance of the average investor. Okay, so from Delbar, they did research and showed that for 20 years ending to 2015, the S&P 500 index averaged about 10% a year, but the average equity fund investor only made a market return of 5%. Now, they measured this basically by looking at the inflows and outflows of retail investors that buy and sell market ETFs. So this is actually a good indicator of the person on the street who's just buying these ETFs, right? And they also found out why that their market return was so much lower than 10%. So in 2018, the average investor outperformed the S&P 500 in both good times and bad times. Investors sense danger in the markets and decrease their exposure, but not nearly enough to prevent serious losses. Unfortunately, the problem was compounded by being out of the market during recovery months. So in other words, the average investor tends to basically not react quickly enough when the market plummets, but more importantly, at market bottoms, they are even slower to get back during the recovery. That's really interesting to think about, right? And so the average investor tends to basically buy high and sell low. The question is, why? I love this chart. So I've seen this chart for years, and I think it's quite timeless. So this is the Wall Street cheat sheet. So I'm just going to use this and talk about this. So here is the stock market prices over here, and what you see over here are the typical attitudes of the average investor. Now I'm saying this is the average investor, okay? So this is the price. This is the price on the y-axis, and the x-axis is just time. So here's something I want to talk about. Look at this point over here. This point is the absolute bottom launching point of the next big bull run. What you see here is not good news. What you see here is not um, hardcore data that says that unemployment is getting better, things like that. Over here is when investors are in disbelief. That means the market pops a little bit more and people are just quick to assume, nope. Now I'm talking about the average investor. The market pops a little bit and the average investor just simply goes, nope, it's definitely going down. They're so confident it's definitely going down. Or they've given up on the stock market already. You can talk to someone and go, hey, have you heard about the news? And the guy goes, I've stopped looking at it already because I'm sick of this market. You know, that's the starting point of the actual bottom. Then as the price goes up, all of a sudden there's hope. As it goes up, not when it's below. The hope comes when it's up. Oh, a recovery is possible. And when it goes up further, oh my goodness, the rally is real. And then at this point here, this is when many retail or average investors, they feel safe to really get in. But they miss the whole entire first move, usually. And then they get in, and once they get in, they start to believe, you know, the market throws in more good news. They see that their profits go up. They start feeling very confident that they're great stock pickers. And then, okay, then after that, their belief becomes thrill. And when they start making a lot of money, they start thinking, oh my goodness, I'm a genius. Every stock pick that I make has made money. Okay, now, and then of course, when the market starts to turn around, the first time it drops and comes up, the investors are saying, hey, we just need to cool off and wait for the next rally. But you know, they don't think that this is actually going to turn down. And by the time they actually start to panic and get out of the denial, they might be over here. See, as the price goes down here, this is when they start getting anxious. They start to contemplate and entertain the possibility that, hey, this whole run could be over, but they find out here. By the time the price comes here, they start to have remorse because they got out too late, and they don't know whether to sell now or not because they've lost all these gains. If they sell now, I'm trapped. And so they get into denial. And finally, when the price goes even further down and they see so much red, they can't take the loss anymore and they're panicking and they get out too late. And so when everyone panics and basically sells indiscriminately, that basically, boom, you have this thing called capitulation, or so-called emotional forced selling. The selling could be emotional or it could be forced. Either way, you're compelled and you can't help it. You're not rational. And when that happens, I want you to note this, very important. When this capitulation forced selling occurs, that usually starts the process of a new bottom. Now, the new bottom might be a V shape, like it recovers straight away, or it could take time to develop. But when it develops, you'll notice that the volatility will not be as bad as before. Now, you might make a lower low and even a lower low again, like this particular chart, or it might just come here and slowly bounce like that and go up, or it might just start going up slowly before it goes up. But the point is that all of a sudden here, this marks the landing spot where a lot of strong hands, I call them strong hands because when they buy at this point, they are very, very prepared to hold on to it for a long time. So we call them strong hands. When the strong hands come in mass, that's where the bottom of the market is starting. Where do you think we are right now? Did we have this phase here where there was forced selling and people were losing their heads? Think about that. Okay, and of course, finally, those who miss the first move of the bounce get even more angry. They get angry that they didn't take part in this bounce. Okay, just saying. So this bottoming process is very frustrating. Let's continue. So how do you explain this, right? So why do the average investor, why do they don't make as much? They would have made more money if they just bought the market and left it as there. Two big reasons that I isolate. There are many more, but these are two which I want to talk about. One is the inability to know which information is more important, and two, the emotional weakness compounded by bad decisions, right? So the thing is, you might think that it's not just that the average investor has emotional weakness compounded by bad decision making. There's also another component. Where do you get your information from? That will also affect you. And let's talk about these things. Okay, so question. How does the average investor receive information? The average investor actually has two levels of uncertainty. The first level is that, well, you have a mountain of data to scour through. Economic numbers, this number, unemployment numbers in Japan, US, China. There's so much data to look at, right? And the second thing is, a lot of this data is filtered through other people's interpretation, right? You see many different types of people. You see analysts, you see academics, you see fund managers who go on TV giving their opinions, and they take the data, right, and they're trying to interpret it, and they make a narrative out of it. So the question is, as an average investor, how do you know which narrative is correct? Which is more correct? Which is less correct? Maybe if you combine 5 narratives together, you might find something. But how do you know whether the person telling you, so of course, the narrative you get will be limited by people's interpretations, whether they are competent, or maybe they see the market the wrong way. So when we look at the market, many retailers see this. They see this mosaic of like a picture of mirrors, right? Like you're trying to figure out what the market looks like, but you're getting different points of view. Each chart here is like one point of view, and you're trying to put the views together to form a picture. And a lot of times you don't know whether you put the chart in the right place, and even when you do put it in the right place, the picture is slightly warped. So you're never getting a 100% accurate picture of the market. It's a garbled mess, and the investor has to get through all those things. So let me just show you some of the pitfalls when you use some of these places to get your news. Okay, so I just want to say that in each of these categories where you get your information from, the point I want to get at is that there are good analysts, academics, and fund managers who give timely and the correct opinions, and there are bad ones. The problem is that as a retail investor, the average investor doesn't really know which is good and which is bad. And that's where the problem lies. So let's take a look at their performances. Okay, so here's a good example. Here's a chart of Amazon back during the dot-com era. 2000, okay? That's like 20 years ago. So Amazon was going sky high. We all know that eventually it popped and the price went all the way down here. Went from what, $100 to less than $10, right? But I tracked basically the recommendations of two houses during this process. You might be a bit surprised to see what comes next. Here you go. So Bank of America Securities had a strong buy call over here. Then you had buy over here, aggressive buy over here, aggressive buy over here, and buy over here. So you might be thinking, hey, that's a lot of buying on the wrong side of the chart. That's just one of the investment houses. Here's another one. You had Prudential saying strong buy over here, hold, strong buy, hold. Okay, back here already is a problem, right? How do you buy over here and then hold over here, then you got whipsawed, right? And then sell. So you had a strong buy up here, and then a sell down here. That's the difference between 70 and 15. And does it get worse than this? Hold. Okay. And finally, fast forward another 1 year, sell. So as you can see, and of course, if you followed this, you would have missed the actual real bull run of the .com. So I guess the whole point of this is that, of course, there are other good investment houses that have good analysts and all that. But once again, as a retailer, how would you know? Okay, and that was back then in the year 2000. Has anything changed? If you go on Seeking Alpha, you see lots of people giving their opinions on stocks and the markets, right? And a lot of them are different, very different opinions. And the question is, how do you know who to trust? So I blanked out this person's name over here. So here, this person was giving advice on the broad markets, right? And the point I want to tell you is that, okay, so now we had a recent COVID crisis. Here it is, the big drop. Boom, right? For whole of March dropped here, boom. What's the recommendation here? I'm bearish. Guess what? The price went up. We had a very significant retracement. Suddenly, he's gone from bearish to neutral. Shouldn't it be the other way around? Shouldn't you be neutral over here and maybe bearish over here? So once again, it's hard for a retail investor to know who's good, who's bad. What about celebrity academics? Okay, you have, in this case here, you have Nouriel Roubini. For those who don't know who he is, he's an academic, economist, teaching in NYU, and he's often quoted on the media, and he's called Dr. Doom because he's always very bearish. Well, Market Oracle basically captured and recorded when he said what during the whole entire 2009 recovery. Right at the bottom here, market to fall another 12%. Unsustainable bear market rally. Stock market to test March lows. March lows is down here. No bottom in sight. Stock market ripe for another 20% fall. Stock market to drop 20% over the next few months. So, hey, you guys know what happened after this, right? We went on the longest bull run ever. But I thought, hey, he's an economics professor from NYU. How could he be wrong? Not all academics are like that. I'm just giving an example of one of them. What about professional funds? Here's something that's even interesting as well. Okay, so over here, if you take an average of all funds in the different categories, so here are the fund categories. Here are all domestic equity funds, all large cap funds, all mid cap funds. So in each category, if you take an average of the performance, all of them, and you compare it to its benchmark. So for example, let's look at all large cap funds. So these funds here, they only trade or invest in large cap stocks. And of course, you're going to compare that to the S&P 500, right? This is where like the large caps are. So here is the percentage of equity funds that are outperformed by the benchmark. That means the S&P itself, 500, outperformed the average, right? I mean, of the fund. After 1 year, 55% of the funds got outperformed by the S&P. After 5 years, 70% of funds got outperformed by the S&P. So that tells you something. Yes, there are great funds and there are bad funds, but on average, they don't really outperform the S&P. Something to think about. So unless you have personal confidence in the fund manager itself, you wouldn't really know which fund to go for, right? Last one. What about the most brilliant of minds? What about the geniuses, the cream of the crop? How do they perform? Well, it turns out that they're not immune to emotional instability either, and emotional instability even makes the smartest people make dumb decisions. So here's a story which I always like to share. Sir Isaac Newton, that's the guy that basically is one of the founding fathers of physics, right? You know Newton's 3 laws of motion? You know, what's that? For every third law, for every action is an equal and opposite reaction. Second law, basically F equals to ma. Yeah, that. So he's the one that invested. He actually invested in the stock market. So here's the story. So Britain's most celebrated scientist was not immune to the monetary charms of the South Sea Company, And in early 1720, he profited handsomely from that stake. So, by the way, this is the chart of the South Sea Company. It went basically from a low of 100 something dollars, pounds, all the way to like 10. Oh, sorry. This is, what's that? Basically, it went up like 10x. Yeah, like some crazy amount, right? So actually, he cashed in his chips, right? And he made money from it. But then he started to see that the stock price continued to rise. So Newton went on to buy more of the shares after he sold it. And he actually bought 3 times the amount of his original stake. And then basically after it crashed, he proceeded to lose 20,000 pounds, which in 1720 amounted to all of his life savings. And when this happened, that's where you get him to say, that prompted him to add and say, I can calculate the movement of stars, but not the madness of men. But the thing is this, how many traders have fallen to the same trap? Even the most intelligent of us, we can be affected by our emotions. And here is the statistical truth. If you are an average investor, your performance based comparatively compared to, say, the different asset classes. So basically from 93 to 2013, the performance of the energy sector was up 12% a year. You know, the performance of, say, um, the financial sector was up 7% a year on average, but the average investor is only up 3% a year on average. Um, so then that behooves the million-dollar question, right? Am I an average investor? Like, what is an average investor? How do you know? Well, let's continue to find out. Another way of asking that question is, am I closer to, on a scale, am I closer to smart money or dumb money? And when I say smart or dumb, I don't mean IQ at all. Okay, one thing I need to say is this, one big disclosure. A lot of people who are not very intelligent and who are not very privileged can actually be smart money. And a lot of people who are professionals, they're smart, they're doctors, they're lawyers, they read all sorts of reports from Goldman Sachs, they can be considered dumb money. And sometimes a person is smart money at some times and dumb money at other times. Like for myself, it depends on what I'm trading and what I'm looking at, right? Sometimes I know I'm smart money and sometimes I'm dumb money. So we can be both at the same time as well. So how do I know where I stack up, right? And what is smart money and what is dumb money? So here's something to to ask yourself, right? Are you smart money or dumb money? Okay, so if you play poker, you know who these people are. These are professional poker players, okay? And joining the stock market is basically like playing a game of poker. And you're playing a game of poker, and the table, instead of professional poker players, you're playing the game with basically every other person who's trading the market at the same time. You're actually playing a giant game of poker, right? And so there's a very popular saying in poker that if you don't know who the fool at the table is, you go to the table and you don't know who the fool is, it might be you, right? So the thing is, if you don't know if you're smart money, you you could very well be dumb money, right? And those people who think they're smart money can also be dumb money. But if you don't know, you're most likely dumb money as well. In other words, right, the key point here is, now you don't have to be better than everybody else, but you do need to know what your edge is over the average of people. Like, you have to be able to say, for this particular trade that I'm making, I think I know more than the average person because I know something that some people probably hadn't thought about, or I'm getting information from a place that other people didn't know about. Or maybe you're in the market for so long, you just know things about the market that the average guy won't know. So you need to know what the edge is, okay? So for example, in each of my successful trades, of course I've had not so good trades, um, I knew what my edge was before I went in. So I'll give you some examples. For Valuetronics, right, I managed to nail the target price twice, okay, and I knew that it was worth more than what the price was. But my edge in this case was that, hey, um, I'm the covering analyst for this company, right? So I had a chance to inspect their actual factory in China. I had a chance to interview the CFO and CEO. So every question I had in my mind, I could ask and ask and ask and ask. I can ask until all my doubts have been eliminated. So I could have more conviction that other people might not have because I could ask management directly so many things. So I had more conviction. That was my edge. Um, for silver, like for example, I said over here, I did this chart before the price actually went there. I said I'm sure that it is worth more than it is now. It's probably worth around 17, and it probably has a time lapse of this much, 2-3 months to get there. And of course, I'm fortunate because the price kind of actually did go there. It hit 17 in the time frame. Of course, COVID crisis occurred and then we had that spike. But guess what? Now we're almost on the way back to 17 again. But the reason why I was confident that this was going to happen is because it wasn't based on technicals, because technical analysis is what many people do. This was actually based on a quantitative study. Like I was doing a statistical study looking at correlations between silver and different asset classes. And that sort of study is not common. Like I know there aren't that many people doing it, and those that do it aren't going to publish their results. So I knew I had an edge on this one. So that's why I had the conviction to buy a lot over here. So that was this edge, quantitative study. Finally, for these two stocks, which, the reason why I had an edge was because I combined what I understood from technicals and fundamentals together for this one. Because in the market, there are some people that do a lot of technical analysis, but they don't really do fundamentals. Similarly, there are lots of people who are really good at looking at companies from a fundamental point of view, but they're not very good at technical analysis, right? So within this space where there's no combination, that's where I lived in. That gave me an edge for these particular stocks. Like I knew enough about the fundamentals and I knew enough about the technicals to make an informed decision. And finally, the most recently, that is, this was the blog post that started this whole journey of getting back into the game of talking to viewers and trying to educate them. Essentially, after taking months of a hiatus, the day before the S&P actually bottomed, I came out and said, guys, beware, beware. I said, an intermediate bottom might be in the process. And I said, we might not be in a free fall for a few weeks, 3-4 weeks. Therefore, I'm going to nibble at those that crashed. I'm just going to start looking into stocks that have already crashed, and I just gave a few here. And here is when I actually launched that report. And when I did this report, I remembered many people disagreed with me. Many people just wrote me off. I remember I talked to this tycoon who's someone who he's not a finance professional, but he invests in stocks all the time and he has opinion about everything. And I just said, hey, are we at the bottom or not? Let's find out. And then he goes, no, it's the way he said it. No, we don't. It's definitely going down. Yeah, there's no point discussing it. It's definitely going down. So it was his reply, the way he replied. You see, it's not that he disagreed with me. It's the confidence that it has gone down that made me think again that, hey, maybe we could be at intermediate bottom. The reason is because the major bottoms are formed when all those people that could sell have sold. So when I'm looking at kind of rich people who are not in the financial markets, and when they are so confident it's going to go down, it means he's probably sold everything already because he's so confident. And if all these people have sold, hey, maybe the bottom is coming, right? But anyway, and then a few weeks later, I said up here that I was taking profit. Okay, so in this particular case, my edge is because I went through the 2009 financial crisis, and back then I was really doing research, like how do you detect bottoms? And so I started to see very similar signs in this move over here. Even though this move was only 1 month, I saw very many signals that corroborated with what happened in 2009. So even though people were really bearish, I wasn't that bearish. I was really pausing, thinking to myself, am I crazy? Everything is so bad. The news is so bad. People are thinking we might have a zombie apocalypse. How can I say it's gonna bottom, right? I mean, people will laugh me out. But I had to stick with the signals that I saw, and I wrote it in my blog over here. Okay, so we have to know the edge. If you have an edge in a particular trade, then you're probably on the smarter side of money. If you don't know what edge you have and you're just depending on other people's opinions and you don't know why you're depending on them, you're probably the average investor. So just to make it easy for you, here's a scale of dumb money and smart money. I'm gonna uh, show you where we stack up. So, and by the way, this is just my own way of framing it. It's not accurate, it's not to scale, and it's just my way of showing it to you. Now, these ranges you see here could easily be smaller or longer. Okay, I'm not saying this is 100% correct, but it's a good way of looking at it. So retail investors are kind of like that. They're towards the dumb money side, but you'd be surprised how some non-professionals can actually be smart money, especially those who have retired from the industry. They were financial managers for a while and they retired from the industry, or they're just people that did a lot of their own research and they're not beholden to um, conventional ways of looking at the market. So some of them can actually be smart money, but most of them will be in the dumb money side. Okay, after which you've got the fund managers, the professional fund managers. They're kind of spread out equally, I'll say, between dumb and smart money. And then you have analysts, because usually fund managers, right, they get their information from the analysts. The analysts basically report to the fund managers. So the analysts are slightly closer to the action than the fund managers. So this is just my guesstimation. Okay, obviously there's some fund managers who are really smart money. Obviously there are some, okay, but it's just that I'm just putting where like the average is. Similar to analysts, there are some who are really incredibly smart, and there are some which are lower, but this is just like an average. Then you have the activist funds like Carl Icahn. The reason why I rank activist funds like higher than fund managers is because these people, not when they make a decision, they actually have a plan to actually increase alpha in the company. Meaning they're not just buying the company and doing nothing, hoping that management will take it to new heights. Activist funds, when they buy into companies, they really want to tweak something in the company to make it better. So they have intentions. That's why I rank them higher. And of course, the very top of smart money are insiders. Now, once again, this is an average, okay? Some insiders are really dumb down here. But on average, you find that if you look at the right ones, they're on top. If you can find who the good ones are, these are the smart money. So how does all these market participants, so all these players are in the stock market at the same time. How do these participants interact with each other in the stock market cycle? So I'm going to put it all together right here, right here. Okay, so let's assume we got this theoretical chart again. All right, and let's just go through here. So don't forget, this is what the average investor is thinking. At the bottom here, you're gonna hear things like this. The economy is gonna take 5 years to recover. 5 years. If you buy any stock, it's not gonna go up. By the way, that's actually what people were saying in the 2009 crisis, right at the bottom. That you hear media saying that the economy will take very long to recover. It'll be flat for 5 years. You hear things like, oh my goodness, the COVID will overrun hospitals. Banks will default. We might get a zombie apocalypse. You're going to have financial crisis here, there, and everywhere. Okay, you're going to hear that at the market bottom. Next, market goes up, right? And on the first recovery, people will be saying, hey, the markets are definitely going to drop again. Then you got, oh, the economy is actually recovering. Oh, hey, look, it's a new normal right at the top. Hey, we should be confident it's a new normal. Yep, I'm comfortable. I'm comfortable with this small drop. And then once you have a major drop, because the average investor is so bullish because they've had so many months of like good returns, they will actually buy in retracement. I bought a retracement. I'm so smart. As the price goes down, they go in denial. Hey, look, I'm a long-term investor. I can hold on. And of course, it goes down further and I hit the market. Well, that's just what the average investor is thinking during this market cycle. But let's look at what the rest of the participants are doing. So in this range over here, you have when I say retailers, I really mean the average investor. like retail investors. So in this range here, retail investors are selling. They're selling, 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 selling. Even when it goes up, they're still selling. Then here is where basically there's much more good news in the economy, and that's when the retailers start buying a lot. And finally, of course, here, this range here is when they start selling again, right? That's what the retailers are doing. What about the professionals? The professionals usually lead, right? Because they're quicker to the action, and so their range of selling will be shifted back, right? They will start selling before the retailers do. But these professionals also still sell during these times as well. Okay, yeah. And then here's where they buy. So typically the professionals buy, somewhere halfway through the first move. Halfway through the first move, people, they're starting to really get bullish, and they pile in, and that causes the second half of the surge, right? And they're going to buy and buy and buy. And towards the second half, usually at the double top, when there's a double top in the market, the second top, usually that's when a majority of the professionals start selling, and they sell. Okay, but the ones who really lead this whole thing is the insiders. Here is where the insiders buy. Now insiders, their timing isn't perfect. Some will buy too early here, some will buy too late here, but some will nail it right over here. Okay, and they're also the ones who are quick to sell. So usually the insiders will sell. Some will be too early, like they sell on this peak here, not the final peak. Some will sell at the peak, and some will sell later on. So this is how the different groups of people usually behave on average during the whole market cycle. So why do I show this, right? Okay, so the reason why is because look at this part over here, okay, the market bottom. How do you know you're at the bottom? Okay, so you have to be self-reflective about this. One, you will have a lot of bad news actually. You will still hear things like the virus is going to overwhelm things. The economy will take too long to recover. You will hear things like that, okay? You will see that many retailers are very bearish. Even on the first move up, they are in disbelief that this is actually happening. But you will have insiders that will be buying. So essentially, at the bottom, all those who could have sold have already sold, right? The retailers have sold, the professionals have sold, and the only ones that have the stomach to actually buy when the price is going down are the insiders. So basically at the bottom, everyone hates the stock price, everyone hates the stock, except for the insiders, because they probably know some things that the outsiders do not know. They've probably done their more precise calculations on whether the company, how well they will do in the new business environment, and they probably think that it's not as bad as what the retailers or the professionals think. Don't forget, at the bottom, the company, as long as the company is not going to do as badly as what the market expects, the price will go up. So it doesn't have to do well, just not as bad. And the insiders are probably the closest people to answer that question. Is it as bad as what people think? Okay, so just remember, these are the things to think about when you're in a market, especially when you're being bombarded by news. People are afraid around you, and even you yourself is afraid. When you start having remorse or anger because you didn't buy, or you lost a lot of money and you are so frustrated, remember that there are many people who feel the same way as you. Okay, and maybe that when that happens, you should calm yourself down and say, stop being afraid. Okay, doesn't matter how much money I lost. Okay, can I make a wise decision right now? Right? If I see all these signs here, I don't know if this is a bottom, but it cannot be too far away. Hence, if I have a long-term outlook, am I happy to buy this stock if I'm forced to keep it for a year or two? If you can say, yes, I don't mind owning this stock for a year or two, you like the valuation, meaning, oh look, if I buy the stock now, I'm going to be getting, say, a 7% dividend for the next 3 years, even in this climate. Am I happy with 7% dividend? For example, yes, I am. Okay, then I know if I buy it, I can't be too far off. So that's what I hope to communicate with you, how to look at this thing. I've given you some theory as to what happens during the bottom. How can I measure the fear of the market? And how can I measure like how much intelligent or smart buying there is? So here are two simplest methods, okay? I think it's good, easy for the retail investor to actually find. That's why I only talk about these two. The first thing is the VIX, okay? So what I show you here is also what I looked at to determine whether the intermediate bottom was in place. So in March 20th, a couple of weeks ago, in my article, you can see I posted this exact chart and I said, look at the financial crisis of 2009. Yes, I know this lasted a year and a half. Look at this coronavirus crisis that's only lasted for 1 month. Yes, I know this is only 1 month. Okay, now here's where the difference is. People who kind of know the stock market but don't truly know the in-depth mechanism, some of them made the mistake of saying, look, this bear market took a year and a half, so this has to be the first move of a bigger move, right? That's what they were thinking because of time. Okay, the thing is, that's not how I look at it. Because if you look at it in terms, because none of us, very few of us are truly experts in terms of knowing how the pandemic is going to finish and knowing the full financial ramifications of giant economies. Okay, let's not kid ourselves. We can't know, right? So what I saw was that the VIX level, here's the VIX over here. The VIX level spiked to a level which was the last time it spiked so high is what caused the very first capitulation in the true capitulation in the financial markets. And I knew that the first capitulation of the financial markets means what happens is that there's panic selling and there's forced liquidations. That means that there are funds that don't want to sell, but they are forced to because of margin calls and everything, forcing the price to probably go a lot lower than what most people think the price should be. Now, and when that happens, that usually signals the start of a bottoming process. So in 2009, what happens is that, see, after the first drop, boom, right here, yes, we consolidated, and then it drifted down, and then one more down to here before a final bottom, right? But you can see after this first collapse, you had a consolidation that lasted a few weeks actually, because because what happened here is that the panic selling recovered to a level which was more realistic to what was going on at the point in time, and then people had to wait for more financial data to determine whether it should go down further. So that's what happened here. So I knew that, boom, we were massively oversold and there were forced liquidations. And I just thought that based on the data that we have, I think that the reality today is probably not here. Maybe it's up here, you see? And it's going to take actual financial data and not fear and panic to determine where we should go after that. So I said, no, I think that this recovery from panic selling should happen, and people will start to think about the data more instead of just going with their emotions. So the VIX is one way to measure it. So even though this took 1 year and a half, and this is only 1 month, but that's not what I look at. I saw how the market reacted, not the time it took to react, how the market reacted. And this told me there was a discount. Oh, sorry, so what is the VIX, right? The VIX is a volatility index. I advise you to go and read up more about it. But the simple thing about the VIX is that it's useful because it measures basically how much S&P 500 stock option holders expect the future volatility to be based on how much premium they are willing to pay for the expectation. I know it's a wordful, but basically what it means is that it measures how much volatility and fear people think the future is going to have, and they're willing to actually pay money for that volatility. So when they pay too much, it means they're basically, I'll say, overcompensating for reality. And most likely when the VIX drops down, you will have a recovery. So as I said, the amount of premium they were willing to pay for that volatility was so high, it was only comparable to the 2009 financial crisis. And in this case, the financial crisis, we haven't even had it yet. We don't really know if it's going to happen. People just thought it was going to happen. So that's how you measure the fear of the market. So as you can see, for minor, not say minor, meaningful retracements, you get a VIX level like that. For full-blown crisis, it's up here. Okay, that's the fear. Okay, so we talked about how to measure fear in the broad markets, right? Remember, the bottom of the market occurs when the market is fearful and you see a significant amount of insiders buying their own stocks. That would be a good indicator that some sort of bottom is occurring. If not the final bottom, maybe it's the one before the final bottom, but the bottoming process has started. So if you look at this chart over here, you'll see that this is the insider buy-sell ratio of stocks in the S&P 500 over the last 20 years, 25 years. So here is the financial crisis. As you can see, during the financial crisis, the buy-sell ratio for insiders went up to 2. And that's only comparable to what has happened recently. So what is the buy-sell ratio? It means that for all the stocks in the S&P 500, this service provider aggregated the total amount of insiders buying, and they divided it by the total amount of insiders selling. And the ratio is what you get over here. So 2 means that for every 2 insiders that were buying, 1 was selling. The point is that here is, you can see the big shift, right? You can see that for all meaningful retracements, you always seem to have a spike in insider buying. And of course, this time around, the spike that we had was only comparable to the financial crisis. And I knew that when the VIX when the VIX was so high and the insiders are equally high, what happened here in the financial crisis is that there was a 2 or 3, 4 week recovery before people started to calm down and to analyze what's really happening in the economy. And of course, whether the economy goes much better or much lower, that's based on fundamentals, right? But it just seemed there was a very big overreaction here in a sense that people were expecting a financial crisis, but actually we don't know whether there's a financial crisis, right? And based on the information that we had so far, those insiders felt that the price is so cheap now that even with what they see in front of them, a sharp recession, that the company is worth more, so they came in. Okay, so there we have it. We found a way to measure fear in the market. We found a way to measure intelligence. So if you want to go into nitty-gritty detail, if you want to ask me, hey Ken, how do you, as a retailer, how can I, easy ways to find the VIX or easy ways to find insider buying and selling, hey, just drop me a DM, just drop me a line, okay? We'll have a chat. We'll just do it, man. We'll just do it. Yeah, let's do it. Okay, so anyway, I'm going to conclude right after this. Okay, we are concluding. So here's that chart we saw before, here's the bottom, and we know that when it bottoms this way, you expect there to be panic out there, you expect there to be bad news, you expect there to be people that are sure that we're going to go into a financial crisis or that it's going to take too long to recover. Then you're going to see retailers selling and professionals selling as well. Okay, you should be on the lookout to see, hey, are there enough insiders buying? Be on the lookout. So while everyone is losing their heads, and maybe you yourself are feeling sad or angry or frustrated because maybe you didn't react in time, maybe you've lost a lot of money and you don't know what to do with your portfolio because you lost 50% and you don't lose anymore. Look, when that happens, right, don't lose your head, okay? Recognize, hey, if I'm afraid, it means other people are afraid. If everyone's afraid, maybe we're close to the bottom. I should look out for opportunities to buy. And the thing is, don't forget, if you actually manage to buy stocks at the bottom, you can double, triple up if it's really at the bottom. So don't be afraid, okay? So here are the things to, I'll say, look out for. Okay, at major bottoms, number 1, most of those who can sell have already sold. All right. 2, the news will be bad. There'll be some good news, but the good news is soft. The bad news is loud. Remember that rule. In a bear market, the bad news is always loud and the good news can only be found on the rocks. You have to look for it. Okay. 3, even some fund managers and some analysts will be bearish. Remember, if the news wasn't that bad, if people weren't alarmed, the price wouldn't be that low. Okay? So when you see retailers around you who are paralyzed, despondent, or even overly confident in their bearishness, oh, it's definitely going to go down. Yeah, I sold everything. It's definitely going to go down. Hey, maybe it's time to think about what's happening. Okay? And then, of course, at the bottom, some insiders will be softly buying into the panic selling. Okay? And don't forget, bonds go up before stocks do in a bear market. So right now, we do have unlimited QE, kind of, okay? I think it was the Fed action was described to be not a bazooka but a neutron bomb. It's pretty big. So the question is, when stocks will bottom, okay? We know that the QA has happened, so we don't know how long it'll take, right? Only time will tell. Okay, and the last piece of advice I want to say is this. It's the psychological makeup of what you must have if you're buying stocks at what you think is the bottom, okay? It's my 2 cents if you're a retail investor and you just want to not lose too much money, you just want to invest at a good time, is this. If you choose to invest in a place that you think it's bottoming, or okay, or maybe there will be another bottom later on, okay, you need to have conviction to do so. Meaning, you have to look at it and say, I'm happy with the returns I'm getting if I buy it right now. Some stocks are having dividends of 7%, 10%. Some stocks, right, when things recover to its original form, might even give 20% dividends. And so you got to tell yourself, hey, if I buy this stock now, I've done my due diligence, I've seen insiders buying this stock, I know enough about the company to feel it can survive 1 or 2 years of bad earnings. And then you go, I'm going to buy it now, and I can't be upset if the price drops further, because we know that the bottoming has started. It's just that we don't know how long it takes, right? So if it drops another 10, 20, 30%, hey, you know what? I know I bought it at a price that all the insiders have bought with me. I'm in good company. You have to take the psychological makeup to tell yourself this. Right now, many people are saying things are bearish, but I have great advisors. My advisors are the CEO and CFO of these companies. These are my advisors. So you know what? If they get it wrong, the best of them has got it wrong. So you put in. But whatever you put in, right, and if you're afraid, don't put everything in. Put some in, right? But whatever you do, whatever you put in, you got to be prepared to hold it for 1, 2 years. If you don't have this mentality, you're going to whipsaw yourself. What's going to happen is that you put the money in, it starts to drop by 10%, 15%, and you go, oh my gosh, I can't afford to lose any more money. I'm going to take it back out. And that's bad, because at the bottom, it'll be volatile. If you do that, the price might just whip up on you. So the only way to protect yourself is to have conviction. If you don't know enough about a company to invest, read up more. Wait for more signs, right? You know what I mean? But whatever you do, when you put it in, tell yourself, I'm going to leave it in for a year at least, 2 years. If you don't have that conviction, you might make a bad trading mistake. Okay? And in all things, be comfortable when you put it in. Okay? If you're not comfortable with it, if you start feeling panicky every time, and you look at your portfolio every single day, maybe it's too hard to invest at that time. Okay? So remember that your peace is important. Do size your position in such a way that you have peace about it, and then you can appropriately buy at the bottom. All right. Thanks for joining me today. Hey, if you like what you saw today, if it was useful, thumbs up if you liked it, subscribe if you love it. Now, if you want to be in touch with me and get timely updates for financial matters and Christian trading tips, I guess, do sign up for kwanzami.com and the Facebook page kwanzami.com, and especially this one. It's a Facebook group, Financial Markets and Godly Wisdom Fellowship. If you want to know more about my journey, how I recovered from incurable eczema for 20 years, and how I managed to recover from that and climb back into God's grace to where I am today, please do check out my ministry pages. This is my website, letters-to-a-modern-day-job.com, and this is the Facebook page, Kenneth W. K. Ko at letters-to-a-modern-day-job.com. And finally, if you want to help us keep the lights on in this place and keep the videos coming, and you want to send us a love gift, we will really appreciate that if you could partner with us. And you can send your love gifts over here. And this is the PayPal. PayPal.me, Kenneth WK. All right, so thank you for joining me, and I'll see you next time.